Good morning, everyone. Happy Thursday. And by the way, this is a very happy Thursday because today is the first day of the new NFL season. That's right, there's actual real games on tonight. And there was real football games on, college football games on last weekend. It's hard to believe that it's spring now, or fall. Part of the reason why it's hard to believe that it's fall is because it's going to be 114 here in Scottsdale today. So it doesn't really feel like fall, but it's not quite fall. But football is here. Today is Thursday. Thursday is my day of my new normal series. The new normal is really just speaking to where our real estate and mortgage industry is headed. What can we do? How can we skate to the puck to thrive in the future? It's the easiest way to put it. I think this may be my 12th in this series. Today go a little differently because I'm just going to kind of go off the cuff and I'm going to just kind of riff. I might even rant. And as I rant, I riff and rant. I promise you that I'm probably going to offend more than a couple of you, and I'm probably going to call me crazy, and you also may call me Chicken Little. But I'm going to talk about what my topic is: the 30-year plan. And here's what it's about. And this is a culmination of a whole bunch of stuff. It's my belief that everything is going to get harder. Everything in mortgage and real estate is going to get harder and harder and harder. But the result is the best are going to get more and more market share, and they're going to have more and more success. So we just have to sharpen our saw to make sure we become the best and that we have the best results. That's kind of my belief. Now, as it goes to the 30-year plan and how things are going to get so much more difficult, I've been talking quite a bit. I've been talking to quite a few C-suite people, owners type, about what we think is the upcoming refi wave. And my belief is the upcoming refi wave might actually break the backs of a lot of IMBs. It's not going to be what we think, and it actually is going to cause a whole bunch of heartburn. And here's my premise. My premise is it's going to be harder and harder for loan officers, for IMBs to retain their past clients. That the competition for those clients is getting fierce, and that unless we 100% up our game, we're not going to be able to retain our past clients. So here's some just general statistics that I'll throw out there, and ones that really keep my mind spaced. Here's the first one. On average, the typical loan officer is successful retaining about 18% of their past clients that refi. So if you have 100 past clients that you've helped buy a home, 100 of them go to refi, you get 18 of them. So 18 out of 100. So we have a really low success rate historically to begin with, because an 18% retention rate isn't high. Now there's an interesting thing about that 18%. A loan officer might have an 18% retention rate, but their company has nearly a 30% retention rate. So the company has an additional layer of retention in addition to the loan officer, whether the loan officer has turned the book over to the company, or the company is trying to retain that client, or the loan officer has left the company and the company has retained the client. But let's just use that number 18%. So let's use that as one data point. The next data point that I want you to consider is, and this is this whole concept we talked about, the whole world of servicing has changed. Historically, I'm talking for decades, servicing was a necessary evil. Nobody liked servicing. The consumer didn't like servicing. Mortgage companies that sold their servicing or their subservicing with a servicing company did not like the servicing company because they were horrible. They had horrible customer service. They had horrible execution. It was just really brutal. Customer surveys historically gave servicers very low marks, very strong complaints. As a matter of fact, you might remember several servicing companies had to change their company name because their company name became so associated so negatively that they changed their name. More than one company did that. This just tells you what the brand was just horrible. That's different though. We have to now change. We have to change our viewpoint. Today, servicers get really good customer reviews, really good customer reviews. They get pretty high customer surveys. They get really high NPS scores, and they're getting better and better. Now, like everyone, servicers are starting to use AI to create individual value-based interchanges with their clients. So they might be sending them offers of things of value every month when they touch them that are highly relevant to that consumer, creating a stronger relationship, whether it's discounts of things that they care about or information about things they need. They're really using AI and a lot of predictive analytics to get people what they want. Now, as we talk about predictive analytics, servicers, which are really big companies and very much tech-driven companies, are on the edge of technology, on the forefront of technology, and they're really using predictive analytics to predict future need. And then they're getting in front of those consumers before the consumer even knows they have a need. They're just being exquisite about it, right? These are the people that are competing for our clients now, our past clients. And what's worse is most of us sell our servicing to companies like this. So we're selling our relationship, our future, to companies like servicers, and it's a huge problem, right? Because as an originating loan officer, I think I own that customer. I think I earn that relationship. But the fact is, the servicing company is doing more to earn that relationship every month than I am, right? Because they're touching that customer 2, 3, 4 times a month. They're doing a great job servicing it. They're doing predictive analytics, so they're getting in front of their needs. They're doing a really good job. And you know how we know this? Because listen to this data point. Last month, I think it was in July, so it's back to July, Mr. Cooper, one of the largest servicing companies, Mr. Cooper successfully retained 72.5% of their customers that refinanced. 72.5. Is that crazy? 72.5%. And that, by the way, that's a published number. It's published in Housing Wire, I think, or Inman. They retained 72%. So if 100 of their past clients, so that 100 of their clients that they were servicing needed a refi, they refi 72 and a half of them. That is a crazy number. And by the way, those people they're refining are our past clients, right? So the battle has completely changed. We no longer, that number that retaining 18% is going down. It's going to go down unless we do something. And so that's what my talk today is. Look, we haven't lost the battle. We just have to engage the battle more strongly. We have to get better to win. Now, before I get on, I'm going to talk about things we have to do to get better. Here's the very first thing. Here, and it's the answer is always the same. When Amazon was out beating the pants off of everybody, what was the solution? It was do what Amazon can't do. And now that AI is scaring the heck out of everybody and fearful of taking jobs, what's the solution? Do what AI can't do. All right, well, now we have giant servicers that are deploying massive technology and giving really good service to their customers, and they refuse to lose on price. You will never offer a lower price than the servicer because the servicer is willing to do whatever they have to do to retain the client. And it's not about the refi to them isn't about income, it's about retaining their long-term relationship, right? And so we're not going to win on price. We have all these problems. So how do we win? How do we win in this environment? Well, what we have to do is we have to make it not about price. We have to make it about value and, more importantly, a relationship. Because what servicers can't do, they can't have the relationship that we can create with the client, with the home buyer, with the homeowner. And here's how we do that. We have to start approaching our clients with a 30-year plan or a 30-year strategy. We have to go, okay, Mr. Home Buyer, you're being referred to me today, but my role is for the next 30, 40, 50 years, I'm going to help you and your family navigate the world of real estate, of attaining the American dream and creating wealth through real estate, right? I'm getting you the financial freedom you want, helping you meet your financial goals, that I'm going to be committed to this roadmap for 30 years. And we're going to start on that roadmap today. We're going to paint a 30-year roadmap, right? Because once I paint a 30-year roadmap, then it takes away from transactional, which is my next question. We so frequently say we're not a commodity. Like, we're not transactional, we're not a commodity. Well, do you operate like you have a 30-year plan? Because if you don't operate like you have a 30-year plan, then you're being transactional, right? And so what we need to do is we need to get out of the commodity business. We need to get out of the transaction business, and we need to get into the 30-year plan business. I think about this when I listened to, I don't have it here. I'll find it for you really quick. I remember listening to a Mortgage Coach podcast that Dave did with Ken DeLeon, and this is the first time I heard the 30-year plan. He was talking about his fees. Ken's the number one buyer agent in America. Number one. He's already done well over $1 billion in real estate this year. And I'm talking him. I'm not talking like some branch, him, right? Now, he's in a very high dollar value area. But he introduced, yeah, you know what? When I talk about my fees, I tell my clients I'm charging them for the 30-year plan. I'm charging them for the 30-year relationship. This is just the first installment. Do we think that way? Because if we thought that way, we behaved that way, then we wouldn't have to fear a servicer beating us or outpositioning us or getting into a closer relationship with our clients, right? And now this goes to another data point. I shared this yesterday. Last quarter, 48% of the volume was purchase business. 48%. A little over 33, like 33.7 or something like that, was refi, and the other 17.1% was HELOCs. So only half the business is purchase. That means in your database, right, there are a ton of customers doing cash out refinances, rate and term refinances, HELOCs. What percentage of HELOCs and refinances are you doing? Because if it's not over half your business, it means you're not serving your past clients or that your past clients are going someplace else. Simple math, right? If you were really, if you wanted to elevate your game to being relational, right, not transactional, well, that means you need to be there for your clients every step of the way, and you need to be there before they need a refinance, before they need a HELOC, right? That's the 30-year plan. The 30-year plan is, hey, we're gonna draft a roadmap for how what role real estate's going to play in your overall financial plan and goals, and I'm going to help you achieve it. And I'm going to regularly check in with you to make sure I understand what your needs are, to make sure that we're calibrated correctly, and to deliver you what you want. That's the 30-year plan, making that commitment. I'm going to talk to you, whatever, once a quarter, and I'm going to provide these tools and values to you regularly, and I'm going to do my annual review, and I'm going to proactively approach you when the opportunities that you're looking for come, whether it's through refinance or finding another property or getting into investment property. But you know what I want to talk about right now is I talk about the 30-year plan. I want to talk about the value, and this is really the bulk of my talk, because this is going to be a long conversation that we're going to talk about. But the bulk of my talk is, what is one consumer worth? What is one home buyer worth? And I wish I could share my screen. If I was technologically advanced, I'd share my screen, because it's hard to conceive math in your head without seeing it on a spreadsheet or on a board. But I'm going to walk through a couple numbers. I'm going to invite you to do this same math, to do this same exercise. Whether you're a loan officer or an IMB, it doesn't matter. Do the math. All right, so we have a few variables we have to figure out, and I'm just going to pick some points, and you can pick your own points, and we're going to come up with a number. So let's say that a customer is referred to you, and their age is 35. Let's say it's a first-time home buyer, their age is 35. What is that relationship worth? So let's look at some of the variables. First, how often do you think they're going to buy and sell a home? On average today, the average homeowner, it's extended. It used to be during the pandemic, the average was 5 to 7 years. Today it's 7 to 10 years because of low interest rates and whatnot. Today it's on average, home buyers are going to buy and sell a house every 7 to 10 years. I'm going to use the low end of that. I'm going to use 7 years, because 7 years used to be the high end. So let's just use 7 years as a historical average. That means that if I stay in a relationship with this borrower, this homeowner, if I stay in front of this home buyer, if I serve this home buyer well, if I serve this person well, then I should have the opportunity to possibly get a new purchase transaction from them once every 7 years. Terrific. Now, let's go to the next thing. How many of these home buyers will buy an investment property? Well, the statistics say it's somewhere between 16 and 20%. 16 to 20% of homeowners in the United States have an investment property. So let's use 20%, right? Let's use 20% will buy an investment property, right? Now, the next value point is, and by the way, here's the next thing. So let's say 20%. Well, the next thing on this 20% is owners of investment property flip their property or sell and buy a property every 5 to 7 years. So the curve gets kind of quicker there, right? So every 5 to 7 years. So if we flip our primary residence every 7 years, and 20% of our clients have an investment property, and those flip every 5 to 7 years, right? The only other variable that we need to know is how many other referrals should I get from this client? And that's for you to choose. But I think a reasonable number is one closed loan from a referral from your current client every 3 years. Now, some of you might argue it's higher, some of you might argue it's lower, but I think that's a reasonable average reasonable. No, I had Dino, I'm not going to try to pronounce his last name, on a podcast last week. He did great. He talked about his customer service platform, his customer appreciation platform, and he kind of has a tiered level of appreciation, with 5 being the highest. But the only way you can attain tier 5 in his system is by actually referring to closed deal. It doesn't matter how many deals you've done. It doesn't matter. It just, if you referred to somebody, then you're in his top tier. I love that. But let's say 1 every 3 years. And here's what this means. All that math, if you just do the math, if you look at my spreadsheet, what this means is that you should get a little over half a transaction, 0.6 transactions from every single home buyer in your database. 0.6 over time, right? If you think that they're going to buy a house every 7 years, 20% of them are getting an investment property, and they're going to turn those investment properties every 5 to 7 years, and they're going to refer you 1 closed deal every 3 years, it comes to about 0.6. So what that means is that over a 30-year relationship, you're going to have 18 transactions from the average person in your database. 18. Now, we don't know what the average loan amounts will be over those 30 years. I used 500,000. Now today's 368, I think, or 370. Over time, that will only go up. I use, let's say the average for the 30 years is 500,000. That's way low, way low. It's going to be much higher, as we know. That means the expected volume that one home buyer in your database, if you nurture them, if you come up close to them, one person in your database could generate just around about $10 million. $10 million in volume over 30 years. If you have a 30-year plan, if you have a 30-year strategy. And of course, if you're getting paid 100 basis points, let's just say on average, some you're going to get paid less, some you're going to get paid more. But let's say you're going to get paid 100 basis points. That means that relationship's worth $100,000 to you. So every home buyer in your database today, if you nurture it, if you treat it like a relationship, if you elevate it above a transaction, if you elevate above a commodity, if you pour unbelievable value to them, if you help navigate, if you help them, if you're the quarterback to helping them achieve their wealth goals through real estate, then you have the opportunity maybe earning $100,000 from that relationship. Think of it that way. And if you approach it that way, then you can fend off against the Mr. Coopers and all of the freedom mortgages. You can fend those people off if you think of this way, because they're thinking of it as a transaction. Now they're thinking it not only as a transaction, but they're thinking it as a number. I want to keep sending them that servicing every single month. But you got to figure out how to get in front of that. And one thing I can tell you, it won't be casual. One thing I can absolutely guarantee you, you cannot take it for granted those customers are going to come back to you. You can't. Because even if they give you a 5-star review, you can't take it for granted. You have to earn their business every day. You have to stay in front of them regularly. You have to pour into them regularly to have the opportunity to realize, to harvest the $100,000 opportunity that person represents in your database. Now, there's a ton more you have to do. We're running out of time today. We'll talk about that another time. How do you get as close as possible to your consumer? How do you convert them? How do you serve them? What tools can you use? What technology you should be using? Because technology should really be high up on your list. One of the things I highly recommend is that hopefully your company or you are using technology that tells you what's the proficiency of your database. That is, how many transactions are you getting out of your database? And they also should be telling you what your runoff is. I worked for a company that did this. They gave our loan officers reports on how many of their past customers they lost every month. It was staggering. You would be shocked. I know everybody would be shocked. Even when rates are super high, a shocking amount of your customers are buying and selling homes and refinancing. And so you got to get to a company that can provide you that. I know that the borrower intelligence platforms, customer intelligence platforms are working on providing that as a regular service. They're not doing it regularly right now because it's expensive data. But when you negotiate with those companies, whether it's Total Expert or Trust Engine, you can negotiate that into your agreement, but you just have to pay for it. But that is required information. How many of your customers are leaving you every month? And like I said, we're only going to retain 18%, and that doesn't include the ones that go and do purchases outside your relationship. But you need that number, because that number will be jet fuel for you to really focus on getting better. There's a fascinating company. Tom Ferry recommended this company. It's called Revaluate. Revaluate. This might be the best thing of this whole life. Revaluate essentially is a really sophisticated analytics companies for real estate agents. And so it gives all sorts of predictive analytics on what their customers need and want. but it also gives them a report card on what their database is doing, who in their database has used other real estate agents, what have they done, all sorts of really great insights using really high tech artificial intelligence type stuff. Check it out, reevaluate. I need to call them because I want to know what they can do for loan officers. Can they do the same things? Because the problem with going to borrower intelligence or customer intelligence platform is they have to have an enterprise agreement. You don't get to do one off. So either your company subscribes or they don't, and then they have to go for a more expensive package to get the runoff. Where I'm wondering if somebody like Reevaluate can actually be any loan officer can sign up for them and get this information on their database. Because I promise you, if you saw that, gosh, Mr. and Mrs. Smith, your best clients ever, just refinance with your competitor, it would really be heartbreaking, and it would motivate you to elevate your game to the 30-year plan. And that's what I recommend. I look forward to talking about this more. Thanks for letting me just rant today. I hope you have a great day. Enjoy football tonight, and we'll be back tomorrow. Thanks. Bye.